Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're talking about the coming financial crisis. You might be wondering how I can say that. We're not seeing any more bank failures since the failure of First Republic Bank, but we are seeing signs of it creeping into the news headlines. Yesterday's Wall Street Journal has zeroed in on the looming crisis in commercial real estate and the associated credit crunch. Well, today the Federal Reserve is meeting, as they do every 6 weeks. Their interest rate announcements will be a few hours after this podcast is published. The bank failures so far this year, while larger and more severe than the failures of 2008, have been explained away by the banking regulators and by federal officials as isolated cases. These banks, we are told, were not well managed. But on today's show, we're going to look at the underlying conditions that led to the failure of these institutions and see if they're isolated to those banks or not. By the time you listen to this show, many of you will have already heard the Fed announcement. Maybe they'll keep rates constant this time around. The drop in consumer price inflation to 4% last month from 4.7% in April may give the Federal Reserve the extra narrative to pause the restrictive policy at this meeting. Maybe they'll raise rates a quarter percentage point, as was telegraphed in the period leading up to the 10-day quiet period before each FOMC meeting. It seems that the Federal Reserve and the Bank of Canada are determined to fight inflation almost no matter what. A little over a week ago, I attended a talk by Benjamin Tull, the chief economist for CIBC. He speaks regularly to the Bank of Canada and Fed officials, and in that talk, he predicted that the Bank of Canada would increase interest rates further. Indeed, he was right. The Bank of Canada did increase interest rates by a quarter point a week later. He also predicted the Fed could still raise rates higher. You have to remember the stress experienced so far in the banking system has been the result of rising interest rates and a fall in bond values. Banks have all been lending money at extremely low interest rates for more than a decade. This has been particularly true in residential mortgages, but it's also been commercial loans, working capital loans for retailers, all manner of loans. The loans that were not floating rate and have long maturities are the 10-year commercial loans, the 20 and 30-year mortgages. In the housing market, 70% of residential loans are underwritten by lending agencies who guarantee the loans for the lenders. These are folks like Fannie Mae and Freddie Mac. In order to understand the problem, an example might be helpful. If a loan was written at 3%, at a 3% interest rate for 30 years, and let's say the loan was written 5 years ago, so there's 25 years remaining until that loan reaches maturity. Let's imagine that the interest rate in the market today is at 6% for a similar 30-year loan. So the difference in interest rate between the loan written 5 years ago and today's loan is 3%. And let's say the lender wants to sell that loan in the open market to a bondholder. They'll package it up with a number of other mortgages into a bond and sell it in the secondary market. The bond market's going to want to receive a 6% return on their money because that's the going rate. So in order for the loan, with 25 years remaining on it to sell in today's market, the loan will need to be discounted until it reaches an equivalent yield to a brand new, newly issued loan today. If there was 1 year remaining on the loan, the seller would need to discount the loan by that 3% interest rate differential. So they would be willing to pay 97 cents on the dollar to get the equivalent of a 6% yield with 1 year remaining. But in our case, there's 25 years remaining in the loan. The lender would need to discount the loan by 3% times the number of years remaining in the loan. So 3 times 25 is 75% discount to the face value on the loan to value that loan at an equivalent of a 6% interest rate. That loan in today's market is only worth 25% of the full value of the loan at maturity. And that's if the loan performs perfectly and doesn't experience any default at any time in the next 25 years. But we're not just talking about one loan in our example. Every single 30-year loan written in the United States in the past decade is worth anywhere between 60 and 80% less today than the day those loans were written. This is the giant elephant in the room that no one's talking about. All 4,000 banks in the U.S. have the same situations. It's the small community banks with just one branch on Main Street. It's the regional banks with dozens of branches. It's the medium-sized banks and the too big to fail banks like Chase and Wells Fargo and Bank of America. So long as these loans are sold off into the bond market immediately after they're written, the banks don't have a problem. But if these loans are sitting on the bank's balance sheet for any period of time, they represent a massive time bomb. The banks are sitting on massive losses in market value in their loan portfolios, even if they don't experience a single default. Silicon Valley Bank was criticized for not hedging their interest rate risk, but all of the bank's long-term debt was low interest rate debt. By the regulators' rules, the banks are not permitted to hedge their assets that are held to maturity, and they do appear on the bank's balance sheet at book value. But if they're held in a short-term bucket, these assets are held on the balance sheet at market value. For performing assets that have declined in value by 75%, I don't know of any hedging vehicle on the planet that will cover those types of loan losses across all 4,000 banks. In the narrative that the banking system is resilient and sound, I'm seeing a massive lie, a lie that's too big to comprehend. I believe that the Fed has no choice but to stop the bleeding in the banking system before it all comes crashing down. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.